Ryan Garland here, CEO of Paradyme. Thank you very much for your inquiry. I'm sitting here with Jason Muller, the CEO of Beach City Capital. We're going to talk today about Catalina Village, which is an investment opportunity in multifamily in Redondo Beach. And so he's the guru behind the scenes. He knows everything about it. He's the developer, so I'll let him kind of speak on it. But we're really pumped to have this up onto our platform. This is going to be a great project, we think, for any investor who has a mindset of cash flow, longevity, and trying to mitigate risk in times like this. So Jason, please talk a little bit about the project.
Thank you, Ryan, for having me. I appreciate it. Absolutely. I think that what makes this project paramount, and I think this is the common denominator for all investable properties, is that it's the location. Right? It's 1.2 acres across the street from the Pacific Ocean in Redondo Beach, California. I've been able to assemble 14 contiguous lots, which is unbelievable. Right? It's like saying, oh, I have a property 100 years ago in La Jolla or Manhattan Beach. This is that property now. Yeah. And so what I just said was 36 months in the making. So it wasn't like it just happened, right? Sure. And I think what's beautiful behind this project is the city government and the landowner needed kind of a liaison that understood urban planning, development. And so my background is architecture, right? And I did urban land use and permits for quite some time. Then I went to SC, and I also worked for a large institutional development company. So I have a long history, about 20 years of doing this. And so I actually didn't really do anything prolific. I literally called a meeting with all the stakeholders, and I had a sketch on a paper. I wish I would have saved the actual sketch. And I went into the meeting, and I really just asked, well, to the city planners and the government, I said, what would you guys like to see on the site? And the walls dropped. Yeah. Because nobody ever asks them. Sure. Right? And so, they rezoned this property to R3, which means all the existing commercial buildings were non-conforming. And they said, we'd love these buildings. We'd love to preserve them. And I go, well, why don't we do a historical overlay on these buildings, preserve the use? And we'll do the housing behind it, and we'll do an affordable housing component so we can help mitigate the entitlement, Yeah, and they're like, that's an excellent idea. And so with that being said, I shook hands with the landowner, and we did a deal to close upon entitlements, which is a great strategy when you're doing development. And it's something that I didn't make up. This is something I learned, with Urban Land Institute, as well as studying real estate development at USC's School of Public Policy there. And so we have been working on this site plan, and we are designing 30 townhomes, and we're also preserving 3,000 square feet of retail, right? On one of the buildings is an old historical blacksmith shop. It has all the cool pulleys, and it was a blacksmith shop that serviced the old red car, right? It's beautiful. It's a great kind of history. And then there's another building that was an old Masonic temple where the fraternal order used to kind of gather to help with city planning, to be honest. Yeah. And so what we did is we repurposed the small retail component to a craft beer tasting room, right, with gourmet burgers. And we repurposed the other building to a breakfast pantry that has gourmet coffee, right? And we're able to put a great public-private courtyard in the middle to provide an amenity for the people, the 1,100 units that live across the street. But we're also designing 30 units on this property in a beautiful coastal plantation-style architecture that fits within the urban context, right? And these are not a merchant build where you're building to flip and sell. This is meant to build and hold, right? So there's a difference, and the paradigm shift between builders that are merchant and developers like Beach City Capital. So we actually care about the design. We care about the environmental impacts. We also care about the longevity of it. Yeah. And so for us in this project, we are designing a product that can hold rental, like a rental product, right, for cash flow. And so this product here, we're going to be implementing tech-based leasing, right? And so people that like and understand that have seen this over the pandemic where tech-based leasing kind of caught up. And so people can actually go online, right, and lease the whole apartment if they would like to, but they can also have the option to do roommate pairing, where they're provided salt, pepper, olive oil, fully furnished weekly cleaning, right? And it's a great product type for the end user, right? It's affordable for like
Sure.
$2,000 to live across the street from the water, right? And the brand new product right by the Pacific Ocean or whatever kind of location might be your preferred kind of, place to live. And it's noble, but at the same time, it also boosts our NOI by 20%. It boosts our occupancy by 300 basis points,
Yep.
but it also provides a watchful eye for our kind of like our asset, right? For the internal kind of review of our like weekly cleaning. And so with this product, I think that the timeline is important, right? I think that we're going to be getting our vested entitlements here in May, which is after 36 months, right? So the investors get the benefit of that value creation now, of all the work the developers have done, right? And you and I have been working together to follow the products to mitigate risk and only really bring your investors in once we're entitled, right? So that's the idea. And so the next step will just be doing the engineering, which is construction documentation, which is just science. It's not like a entitlement risk there. And we'll be building the product. And the idea is that we're going to be building this project for cash flow. And our projection is to be, for the performance to hold it for 5 years, right? And so this product, for instance, if somebody comes in and is interested, they're an accredited investor, go through your screening process, and they sign the PPM. The beauty behind this product is that if they invest $100,000 or $1 million, they're able to accumulate an 8% pref during the entire development product, right? The idea is that once we build the product, we're going to refinance the property once it's fully stabilized, buy the construction loan out with, Freddie and Fannie or CMBS, take out financing at 3.25% rate, and there'll be a big pop there. And so what happens is all the investors are in, they get a true up, so they get about a 20% pop on their cash. So they put in $100,000 and they get about a $20,000 check, and then thereafter, the beauty is that they get cash flow, right? And so you get about a 5% pref on your cash for cash flow. You get a 70% upside. And so that calculation is well above a 10% cash on cash in California, right? So that's something that people need to pay attention to because this product is a rare product to be, coastal in Los Angeles, in California. And along the way, you get cash flow, but you also get to hedge inflation because appreciation in real estate is the best hedge against inflation. Number two is you're also benefiting from depreciation. Because you get your depreciation credits when you do your taxes every year. And then once we sell the product, you get your fair share of the upside. And so on this product, you're looking at about a 2.6x equity multiple. So if you put in $100,000, your take will be about $260,000. Right?
I love it. And your capital stack, which I always like to talk about, right? Because I'm the numbers guy too. So you're looking at your construction loan, your C-PACE, which is killer. I keep talking about this. Green building material. The government's giving you funding for that. Therefore, you can do more institutional grade leverage. Therefore, you're actually not having to raise as much equity. Therefore, the returns to the investors are a little bit greater because you're able to get more of a straight rate, but covering more of the debt. So, which is killer. And then obviously at the very end, so what's the length of the term?
So for this product, we're going to be building it here, and then we're going to be holding it for 5 years. So it's about a 7-year average. Okay. But the beauty behind it is that you're going to be getting cash flow all along the way.
So at say year 3, right? They get a big pop at the time of a capital event, whether it's a refinance, which typically that's what it'll be. At the time of CO, right? So then you guys refinance it. Is it going to be stable or is it CO?
It'll be at stabilization.
Got it. Mm-hmm. So at stable, you refi, investors get a big pop, and then they get cash flow every quarter from there to the end of the term, which is in essence 7 years.
Right.
Perfect. Correct. What's that cash flow? What's the return?
It'll be about an average, calculated about 10% cash on cash return for the cash flow portion of it. So you get a 5% pref with a 70-30 split. The 70% goes to the investors. And then at disposition, it follows the waterfall structure per the PPM. But the overall average should be about a 2.5, 2.6 equity multiple for investors. So if you put in $100 or $1 million, at the end your takes is about, if you put in 100, it's about 250, and if you put in $1 million, it's about 2.6 million.
Yeah, it's a big bump.
Right,
it's massive.
It's a big bump.
And the idea is to think kind of a long-term play. Right. So whether it's this one or your opportunity zone projects, 7 to 10, and that's what real estate should be, especially from apartments. Really, apartments are kind of good for cash flow. So to be able to build a brand new product, repurpose units that are, used as zoned historical that the city really wants to see.
Right.
You have great amenities there, right?
Right.
And then, and plus you said 1,100 units across the street, so that density's there.
Right.
And then obviously building a new product where you're probably going to have more of a desirable unit for people in the area to look at because it's a brand new product. So therefore, you're probably going to keep it leased up.
Oh yeah,
right?
definitely.
You have the ability to cut your costs because you are going with a tech-based lease-up company,
Right.
which has a great track record and and is
definitely.
growing at an unbelievable rate.
They're number one in the nation.
Yeah, and they have the best so far during the pandemic, right? As far as lease-up and occupancy rate.
Right.
So that's a big. That's something to really consider,
Right, right.
Because a lot of people go, "Who's your operator?"
Right.
Right? Who's your operator? Well, this is our company. It's an operator, but you're cutting your costs by using them as an operator.
yeah, definitely.
And their data.
I do everything.
Data doesn't
arm's
lie.
length. Yeah.
Yeah?
Their data
So-
does not lie.
Well, data doesn't lie.
Yeah.
So you're, in my perspective, you're kind of checking every box, right? So for any investor who really is looking at hedge against inflation,
Right.
really likes apartments, believes California in this location still doing good, right?
Right.
Which, my
Coastal.
opinion, anything coastal,
Right.
I really do believe in. But this is a great product, especially when you have the cities backing you.
Oh, yeah,
and
definitely.
the nature of how you acquired this land and how you kind of put it together. They always say it's where you make your money is in your acquisition, right?
Got it.
And if you're able to take an area like Redondo Beach and you're able to, in essence, create the strategy and structure like you have, and now you've acquired that much land in Redondo to build this product and stay in line with the city, enough said. Right?
Enough said.
So,
Yeah, I agree.
yeah, it's an honor to have you on the platform. For any investors who are looking at getting more details, there's going to be a pitch deck and a link below. Feel free to click on that and read all the data you can imagine. We are also setting up calls. So if anybody would like to talk to Jason or myself, we're happy to jump on a call with you as well. So Jason, thank you very much for having us,
My
and
pleasure.
thank you very much for being on our platform. It's an honor.
My pleasure, Ryan. Thank you so much.
Thank you, buddy.